Hey guys, Michelle Kinney here. Thanks for checking in. Thanks for checking out my video. I often have people on my YouTube channel ask me about looking up different stocks. So this one goes out to someone on my YouTube channel that asked me to check out BBAI. Now, I had never heard of the company, so I looked it up and I'm going to show you exactly the steps involved when you're thinking about investing in a company, you're thinking about selling options on that ticker. I'm going to show you all the steps involved on what to do. So first, what I did was I pulled it up in my chart and I'm going to share my screen here. Okay, so the first thing that I want to do is take a look and see where the stock has been over the past year. Now, a few other people had asked, hey, I want to trade options. I don't have a lot of money. Tell me about some very low cost tickers. So this video goes out to them as well. The stock right now is only trading at $7.19. So it's a very, very low cost stock. So this right here is a 1-year chart. So it just gives you an idea of where the stock has been. And let's take a look at the options, right? So today is Saturday, so the market's closed, but I'm going to always look at a 1-week option chain. So I'm going to look at October 10th. That's going to be this Friday. And you'll notice the strikes down the middle. And in this particular ticker, there are strike increments of 50 cents every 50 cents. So you'll see the stock is trading at 7.19, and you'll see a $7 put, 6.50 put, $6 put. If we're looking at the call side, which is on the left, you're going to see a 7.50 call, $8 call, 8.50 call. Now, the first thing that I did was I wanted to see if this stock is eligible to trade using margin. So to do that, I just want to check out the $7 put as an example. I'm going to click on the bid and I'm going to go ahead and right click just to take a look. This is thinkorswim. I'm just going to take a look and see what the margin requirement is. I'm going to click on analyze trade and it brings up a box right here. So you can see right here, the margin required on this particular contract is $700. That means that this ticker is not able to have margin. So right off the bat, that gives you an idea that it might be a little bit more aggressive of a stock because it's not eligible to use margin in order to trade it. So let's take a look. So we see a $7 put that expires on Friday, but I want to go a little bit lower. I want to look at a $6.50 put, and I just want to calculate the rate of return. And we can see the delta here is 22. So what that means, guys, is that it has approximately a 22% likelihood it's going to close before 6.50 on the expiration of the contract, which is October 10th. I want you to notice a couple of other things. I want you to take a look at the implied volatility. Super, super high. Anytime we have implied volatility over 100%, that means it has a lot of swing, right? It can go up a lot and it can go down a lot. But that's usually a good sign when it comes to selling options, because the higher the volatility, the more premium you get paid, because there's a little bit more risk of a stock. I also want to point out one other thing to you. If I look at the chart here and I take a look at the icons, this just shows us the earnings per share. So you can see it has most recently negative earnings per share. If I just hover over that, negative 0.065. And then let's take a look at the prior earnings. Prior to the most recent earnings, again, negative. And if we go to the one prior to that, again, negative, and then negative. So negative earnings per share, basically that means that the company is really not making a profit. It's not necessarily a bad thing. Tesla for a very long time had negative earnings per share, and yet I was able to trade it, very successfully, because it would go up, it would go down, and you're making money selling puts, and if and when you have to buy the shares, selling calls on the other side. So all the things that I'm talking about in this video, I want you guys to understand it's not necessarily like a bad thing or a good thing. They're just things that you want to look at when you're taking a look and seeing, is this a stock that I want to trade, right? So let's go back to the options chain here, and let's just pull up a calculator. Okay, so I have a calculator. I always want to calculate what is my annualized rate of return, right? I never ever put a trade in before calculating this. So I just want to take a look at a 650 put. A 650 put that expires Friday is basically saying that you're taking in premium, right? The premium gets dropped into your account right away, and you're committing to buy 100 shares at the strike price, in this case, $6.50, if the price drops below $6.50 by the expiration date. So we can see that this right here, the bid is 10, the ask is 15. It last traded at $13, right? So let's calculate our rate of return. So we're going to calculate $13, which is the premium that we're taking in. And then we're going to divide that by the capital that we're required to put up in order to make that trade. Now, in this case, because it's $6.50 strike price, we're committing to buy 100 shares at $6.50. The commitment is $650 because $6.50 times 100 shares, each contract always represents 100 shares, is $650. So we're going to divide the premium of $13 divided by $650, and that gives us a rate of return of 2%. Now, remember, guys, this is an October 10th contract, so we're only holding it for 1 week. So we're going to multiply that times 52 to get our annualized rate of return. So on this particular trade, we're making 104%. Before you sell a put, you want to think, is this a stock that I'm okay purchasing at that particular strike price? Now, I don't know a lot about this company. I don't trade it personally. I'm just doing a video because somebody asked me to. But I did look up this company, and they're an AI company. So an AI technology company, they're very involved with the Pentagon and the Department of Defense relative to AI. They have a lot of government contracts. And so that might explain the negative earnings per share. Oftentimes, when we look at technology type companies, they reinvest a lot of their profit back into research and development. So going back to the negative earnings per share, that might be a contributing factor. And the fact that it has high volatility makes sense because it is an AI company. So typically technology companies, AI type companies will have high volatility. So let's just break this down and talk about exactly what this means, right? So if we were to sell a $6.50 put, we're taking in $13 in premium, we're putting up $650. And what we're doing is we're committing to buy 100 shares if the price drops below $6.50. If it doesn't drop below $6.50, we don't buy the shares. Either way, we keep the $13. Now, the great thing about selling a put is if and when you do get assigned the shares, you can turn right around and sell a call against those shares. Let's take a look at a covered call. So let's say you already own 100 shares, or you purchase 100 shares when the market opens on Monday, as an example. So as I said, the stock is trading at $7.19. So you would have to put up $719 to purchase the stock. And let's say you sold a $7.50 call right after you bought the shares. Now, why did I choose $7.50? So here's how I do it. And there's no right or wrong answer, but personally, when I'm trading options, I am trying to capture as much premium as possible. I care about the premium. I don't so much care about the stock fluctuation. That's kind of a bonus. So if it goes up and you make some money on the shares after you sell the shares, that's kind of like a perk. But my intention is always creating premium every single week because that's guaranteed cash that I can keep in my pocket, and that is cash flow that I can spend, right? So going back to my example, let's say I purchase 100 shares at $719 and I sell a $7.50 call 1 week. That's the next strike price over what I paid for the shares. Well, that is trading at 30. Let's take a look here. 30 bid and 35 ask, and it last traded at $32. So let's calculate the rate of return. So if we make $32 in premium and we're putting up $719 because we're purchasing 100 shares at $7.19, that gives us a rate of return of almost 4.5%. But again, remember, it's for 1 week. We're going to multiply by 52, and that gives us our annualized rate of return of about 231%. Super high rate of return. And that's to be expected because when we look at the volatility, like for example, this $7.50 call has an implied volatility of 130%. So anytime over 100%, the higher the implied volatility, the more swing the stock has. And generally speaking, the more we get paid in premium. So from a rate of return perspective, this stock has a very, very high rate of return. From a fundamental perspective, I can't really speak to that because, again, I'm not familiar with this company. It seems to be an AI company. AI is pretty cool nowadays. There's tons and tons of AI as time goes on. AI becomes more popular. This particular stock has government contracts, which can give it a little bit more credibility, perhaps. And it is only trading at $7.19. So it's a very, very low priced stock, meaning that if you have a small account, this stock might fit into that. Also, if you want to be a little bit more aggressive with your portfolio, this stock might fit into that as well. So anyway, I hope that helps. If you want to know more about how to sell a put, how to sell a covered call, I have some links in the description below. Thanks for watching.